And we're live.
Good morning, everybody. Welcome to a special edition of today's self-directed IRA Saturday here with Quest Trust Company. We actually have a couple of different guests with us today. I am super excited to have both Eddie Wilson from Think Realty and the American Association of Private Lenders and Richard Wilson from the Family Office Club here joining us today as our panelists in our Forecasting 2021 panel. So this is a special event that we've put together today. We've actually had almost 400 people register. So I'm super excited for the content that we are going to be covering in the 2 hours of today's presentation. If you guys want to rewatch this presentation, as well as any other events that we host at Quest, be sure to subscribe to our YouTube channel. So we're actually streaming this entire event through YouTube. You'll be able to rewatch the entire thing. Be sure to subscribe. It's one of the buttons somewhere in one of these corners. But before we get started, since I do know that we have a lot of new faces joining us today, I do just want to take a couple of minutes, kind of let everyone get signed on and give you guys a quick little rundown of how we can help you here at Quest. So at Quest, we are a self-directed IRA company. We're based out of Houston, Texas, but we have clients pretty much all over the nation. We can operate in all 50 states. And we basically teach investors how to diversify their retirement portfolios by learning how to invest their IRAs into non-traditional assets, things such as real estate, notes, private placements, all sorts of alternative assets that you can actually hold in an IRA. But not many people are really aware that you can do this. So this is just one of many events that we host. We were actually just talking before we started this stream. Before COVID, Quest hosted about 600 events a year. Obviously now in this year, everything is online. Everything has changed a little bit. So I'm really excited to bring you guys today's questions and information to see how we can really look forward into 2021 and how Quest can help you really maximize your retirement savings and your overall, wealth building for your retirement account. So we've got about 20,000 clients across the country. Physically, our offices are in Texas, but we do have clients in all 50 states. And we're a pretty good-sized company. We're not the largest out there. We're not the smallest. We're definitely kind of a homegrown Texas company. And we really, really like to focus on building relationships with our clients, helping you guys learn how to use your IRA to do all of these different types of alternative assets. But the most important part of my quick little 5 slides here in the beginning for you guys is our disclaimer. So please be aware that this presentation, just like every presentation that we give at Quest, is strictly for educational purposes only. We're not attorneys. We're not your CPA. Please, please always do your own due diligence before entering into investments. Kind of standard disclaimer, but you've got to do it. So why are the IRAs that we hold at Quest different than your IRA that you might have at Fidelity, Charles Schwab, all of those more traditional custodians out there? They are really only set up to allow you to hold publicly traded assets in your retirement account, things like stocks, mutual funds, CDs, kind of those more traditional investments. The self-directed IRAs that we hold at Quest, really, there's no legal distinction. The only difference is at Quest, instead of having stocks and mutual funds held in your IRA, we allow our clients to use their IRAs to invest into privately held assets. Now, these assets are actually held in your IRA. So all of the profits from these deals, they still go back into your retirement account. But as you can see, there's a lot of investments. Not going to spend too much time on these here, but it's a really great way to diversify your retirement portfolio. Your IRA grows completely tax deferred or tax free, depending on what type of account you are investing with. And the biggest thing here is, as real estate investors, we all kind of have our niche, certain areas of real estate investing that you are good at, that you are knowledgeable about, and you have a certain skill set to help you make money by doing these deals. So you might as well use these skills and this knowledge that you already have as a real estate investor, apply that to your retirement account, whether it's an IRA, maybe an old 401k, maybe even a health savings account, which I'll kind of get to in the next screen here. But you can apply all of these investment strategies that you are knowledgeable about. Some of them we are going to talk about today, and potentially grow your money completely tax deferred or tax free, depending on what type of account you're investing with. So, to be honest, a lot of our clients at Quest, they hold IRAs at both types of custodians. Maybe you have your IRA at Fidelity, and then maybe you also have your IRA at Quest. So you can really, truly keep those funds diversified. But I will let you guys know I allot myself about 10 minutes for these introductions. Give us a call, talk to an IRA specialist if you want to know more about the ins and outs of how these accounts work, how you can really benefit from these. Reach out to us. I'll have our contact information here at the end of these slides, and we'll set up a free consultation with you and really tailor the conversation to your personal situation. And the reason why I like to say that is because there are actually 7 different types of accounts that can be self-directed at Quest. To really, really have a good, intimate understanding of which types of accounts you qualify for, how much you can put in via contributions or rolling over an old 401k. Again, set up a consultation with us. We'll walk you through it. And our IRA specialists, there's about 15 of us that have pretty extensive training to help guide you guys through all of these processes. But we are actually trained to ask you certain questions. Do you have an old 401k? Do you have a Roth IRA? Are you self-employed? Maybe you qualify for some of these 3 plans here in the middle. And last but not least, definitely not to be overlooked here are these specialty plans here on the right, the health savings account and the Coverdell education savings account. These plans are really awesome. To be honest, they are very much underutilized because not a lot of people really have a great understanding of how they work. But the HSA and the Coverdell education savings account, they can be self-directed just like all of our other IRAs here at Quest, but the money can actually be used today, completely tax-free, to pay for any of your qualified health expenses or even your children, maybe grandchildren's qualified educational expenses from kindergarten up until age 30. Now, where the real magic kind of comes in with all of these types of accounts is, a lot of our clients might have multiple of these. They might have a Roth IRA. Their wife might have a Roth IRA. They might have a health savings account. You can actually partner all of these accounts together, divide up the percentages of ownership on your deals, and grow multiple buckets of money at the same time, not just for your retirement, but for today's expenses as well. Those health expenses and those educational expenses can all be paid for with tax-free dollars. Again, just give us a call at Quest. We'll put our contact information here in the comments throughout the presentation so we can really help to guide you one-on-one how this process works. Now, once you have your account open, once you know which types of accounts you're ready to self-direct, now it's time to choose what types of investments you would like to do. Really important to designate here that Quest does not sell investments. We are a neutral party in this. We're basically the vehicle that allows you to use your IRA to invest into privately held assets. So whether that is real estate, apartment complexes, commercial deals, promissory notes, just some of the many different things that you see here on the screen. Again, it is 100% self-directed. You actually get to choose what types of investments you would like to invest your funds in, how those deals are structured, the terms, who you choose to work with. You have a lot of flexibility. Again, it's just so important to make sure you get the right education, you do the proper due diligence. And, Quest is always here to help to point you in the right direction. Again, give us a call. We can kind of, tell you about your different options and about some of the different resources that we offer for you as well. This is a pretty basic overview of how the process works. Again, kind of a broken record here, but call an IRA specialist. We make the process really easy for you. We get a lot of calls from people that are like, I've heard about this self-directed IRA. I did some reading online and it seems really complicated. And to be honest, that is really not the case. We'll help you get your account open. We'll help you get your account funded. And once you're ready to start investing that IRA, just give us a call. Our transactions team will walk you through exactly what needs to be submitted to us, what forms need to be signed, all that fun stuff. And once we have everything that we need from you there, Quest is very fast when it comes to funding investments. Our customer service and our speed in these funding times is definitely something that really sets us apart from our competitors. As far as the timeframes go, 24 to 48 hours to open up an account, 24 to 48 hours to fund an investment once we have the documents from you. Now, the reason I like to talk about the timeframes here, though, is because this step number 2, funding your account, this can take a little bit longer. Average 1 to 2, maybe 3 weeks. Sometimes it does take a little bit longer. So if you are ready to start investing, you're actively looking for deals to do with your retirement account, give us a call. Let us go ahead and get this process started for you. That way we don't get hung up on waiting for your funds to arrive from your current custodian, and we can fund the deal pretty quickly at that point. Now, again, a couple quick little minutes for you guys here at the beginning. I kind of like to do these little introductions just to make sure that you guys kind of know who we are, what we do. We get a lot of new faces on these big events, but also just to let you guys know about all of the different resources and education that we offer. One of my personal favorite events that we are hosting these days is our virtual networking happy hours. These are the first and third Wednesday of every month at 6:30 p.m. Central Time. Our next happy hour is actually this upcoming Wednesday. I believe that is the 16th. Yes, it is the 16th. I will put the links for all of these in the comments here on YouTube, but be sure to check out our events. We have a lot of education. We have a lot of networking opportunities. Even when some of these, larger events, we're not able to host as many in person as we all love to before this year, we still have a lot of great opportunities for you guys. And one slide I actually forgot to put in here is if you are interested in opening up a Coverdell Education Savings account for your children, we actually have a really awesome little promotion gift basket thing going on this month where we'll send you a free little Questy the Pig. We'll send you a little activity book for your kids to complete and kind of color, learn about some financial terms and, kind of make it fun for them. And you can actually show your kids that you are saving for their education, again, anywhere from kindergarten up until age 30. But let's see. Let me go ahead and stop sharing my screen. There we go. That's all I have for my quick announcements for you guys. I hope that you find our resources helpful for you and kind of giving everyone a minute to sign on. I know we're hosting this event a little bit earlier than we normally do on Saturdays, but that is all that I personally have for you guys. Without further ado, let's go ahead and get into today's event. I'm going to pass the torch off to Nathan Long, our president here at Quest Trust Company. Nathan will actually be moderating today's panel. I will kind of be here in the background, maybe responding to questions and having the questions pop up on the screen for you guys. But Nathan, thank you so much for moderating today's panel for us. I'm super excited to go ahead and get into you, and I'm going to stop sharing now.
Well, thank you, Haley. Very nice start and really good, quick little presentation. I like that. That's always good to kind of review the basics. I love today's topic. Eddie, Richard, thank you so much for coming out and sharing your wealth. I know you're out there camping with the boys. Out of here, Richard, always I got to tell you, I've been involved in real estate for a long time. We started in the early 80s, right? So I've seen some. I watched it crash. I watched it go up. I watched it crash again. Watched it go up. Watched another horrible crash. I ain't never seen anything like 2020. Right? So I think that the questions we're going to ask and stuff, and the things we're going to investigate through this are really important. I'm not going to introduce you. I'm going to allow you guys to introduce yourself and tell us why I brought you on, or why we brought you on, and why your knowledge and experience in answering these questions is so valuable. You want to start, Richard?
Sure, I'm happy to. Thanks, Nathan. Thanks, Haley. So 13 years ago, I started the Family Office Club, which is a community of ultra-wealthy families and family offices and private investors and angel investors. And over that time, we've hosted 150 live events in our community, and we've produced a lot of thought leadership. We basically kind of document the best practices of families that are worth 5, 10, 20, 50, 100 million plus, and just share what all of them are doing after they learn things the hard way after 4 to 7 years, versus what everybody does when they first either sell their business or get their first $300,000 to invest or first $500,000 to invest. They almost all make the same types of mistakes. So we kind of document that And a lot of the things I'll be sharing with today are the things that my investors are doing. We have 300 investors under contract that we represent, help source deals for through privateequity.com. And so that those text messages and negotiations and deals and the deals we're structuring, and then just meeting with, about 2,500 family offices in person over the last decade is really where a lot of the comments will come from in my talk today.
Thank you. Eddie?
Sure. Yeah. So again, I am camping out here in Arizona. So if there's background noise, I apologize. I am the other Wilson, even though Richard and I are not relatives. I guess you guys just picked the two best Wilsons in the country to come on today. But my background, I'm actually a media guy, but a serial entrepreneur, and so I've owned over 100 companies in my career. I've had well over 4,000 employees, but had quite a few exits last year. But the two assets that I really was excited to hold on to out of the 70 some companies that I sold last year was a company called Think Realty, which was a kind of a brainchild of mine 4 or 5 years ago, just because no one had aggregated the real estate investment industry. I had an insurance company at the time and was just looking for aggregation. And so we created a media source for the real estate investment industry. And that media source, Think Realty, reaches about 1 million real estate investors a month to any capacity, whether it's our digital presence or our magazine that you pick up on the shelves of Barnes & Noble, so on and so forth. And really that is from someone who's coming into the industry, maybe someone who's watched an HGTV show or has some level of interest, taking them into the finer understandings of real estate investment, leverage, all of those pieces. And then the other company that I held on to is the American Association of Private Lenders. The AAPL is a for-profit association for private lenders. Again, dealing with the upper echelon of real estate investors typically, or high net worth earners that are wanting to play more on the lending side versus holding the asset. And so that's the American Association of Private Lenders. We've got around 500 members that are private lenders across the nation. And most of those are either someone who has a discretionary fund that they're lending out of, or someone who has created some sort of a brokerage arrangement to secondary market capital, so on and so forth. But those are the two organizations I represent today. So when we're talking about forecasting, Nathan, obviously I'm kind of hitting it from 2 points, both the real estate investor, but then also the lending side as well.
Right. Wonderful, wonderful, wonderful. You guys ready to just jump into it?
Do it.
I think the first question says it all, right? As we move into 2021, right? What should we be doing now? Because I think there is a difference between what you do now and maybe what you're doing in January, right? And what are some of the things that you're doing to prepare for next year, if any?
Yeah, I'm happy to go first.
Go ahead, Richard.
Yeah, I think right now obviously is a good time to do end-year tax planning. And hopefully you already have a lot of those moves into place, but there's some things you can't go back and do once the year is over. So I'd be looking at tax planning that you should be doing this year. And then if you're already too late to do some things, to make sure you get that into place for 2021, because I don't know how quickly the tax code might change, but Biden has publicly said that his goal is to raise taxes on anyone making over $400,000 per year. Who knows if they'll maybe go up a little bit for people that make a bit less than that. But I think tax planning is obviously top of mind this time of year typically. And with Biden being elected in at least some people's minds, I think people are even more so talking about that with me. And so investors are looking for tax efficient investments to close out the year. And they're making sure that their plans are solid on the tax side. I see that's where 80% of the energy is right now for most of my clients.
Yeah, we always at Quest try to encourage people to do a end of the year checkup with their IRAs, retirement plans. Even if they're really familiar with everything and been doing it for a long time, call an IRA specialist and just talk to them. It's free, and a lot of times they have a little different view. It's not quite tax planning, but it's a part of it. Something that you need to do at times. Eddie, what are you doing?
Sure. I think Richard said it best. Tax planning's of the utmost importance as we go into the next year. I think from a business perspective, I think that we as a nation have this survival mindset. We've gone through this year, we're planning, we're trying to make sure that we can elongate our path as businesses. I think that we have to somehow figure out how to get out of survival mode. Our companies, our employees can only take the stress of that feeling under that pressure for so long before there begins to have attrition. And I think that we have to figure out how to get outside of that. It's difficult because obviously with the changing administration potentially, or most likely, it seems like there's going to be a lot of changes. I mean, everything from, potentially Biden creating a new tax program, as well as potentially messing with 1031 exchanges, potentially touching, the opportunity zone legislation. So there could be a lot of changes. However, I think as leaders, we have to really find a way to find potential and opportunity and begin to share vision again for where we're headed and the opportunities ahead of us, rather than just looking at the opportunities of failure in front of us. I think that for so long, business owners, we've looked at our flight path and we said, okay, how long can we survive like this? Event-based businesses like the three of us all have, you look at it and you go, how long can we survive without events? Do we have to change the model? What do we have to do? And we're constantly making these changes, but I think it gives our employees the feeling of unrest. And so we have to really get set in the plan, even if it's a modification of our former plan, just a plan that they can buy into, settle into, get behind, get excited about, and really start sharing that vision again. I think as real estate investors, we're typically opportunistic. We're always looking for the opportunity. However, I've found a lot of businesses that are really stuck in that survival mode. And I think we really need to start adjusting how we're leading our companies.
I think you made, for me, there's a couple of points good that you made there is, as legislation does change, often certain things, especially dealing with IRAs, are grandfathered in. So if you don't have a health savings account, you don't have a Roth IRA, you don't have a Coverdell, you should be opening these types of accounts because they might allow them to continue, but might not allow you to open them or have them or do something in that way. So I think that's really important. I want to focus on the second part of this question. What are you doing right now to create that? What are you doing to prepare for that?
Yeah, sure. I'll go first. Right now, we're closing on an investment in a dental clinic where every dollar is 100% depreciation, same year here in 2020. So we're closing on that investment, structuring that right now. We should close it on the 20th of December if everything goes as planned. I have a just under $2 million house in Florida that I don't use and is really not performed well as an asset on my balance sheet. So looking at a engineering study, like a cost sake study on that, which you usually don't do on a single family home, but it might produce $300,000 of income protection for about $2,800 of doing a study. So we're in the middle of doing that right now. We also acquired Scottsdale multifamily cash flowing property about 3 months ago. We're doing an engineering study on that right now. And I'm also negotiating, we've closed 5 gross revenue royalty investments to date, and we're negotiating the next 3.
Is this different than it was a year ago, 12 months ago for you? You know what I mean?
For sure it is, yeah.
What's different? Are you trying to close more at the end of the year, or,
Yeah, a couple things are very different. I mean, one thing is that in March, I kind of got shocked by what was happening. And I was in New York. We hosted an event on March 12th in Manhattan in Midtown. And March 13th, it's like everything in New York shut down and the subway systems were empty, et cetera. And, for that next 10 days, we had to redesign our business, just like you guys were probably in similar conversations. And we decided to react by going into kind of high action mode. We started scaling up our digital privateequity.com investor platform. We started doing virtual events and leaning into what we were strong at, which was thought leadership, as well as structuring investments using an income model for investors. I also realized at that point, and I thought Trump would be reelected for sure at that point. So I wasn't smart enough to see that he may not. But at that point, I realized that I needed to dig into the tax side of things And after running the Family Office Club for 13 years and doing a lot of interviews and conferences, like you guys know that sometimes you're traveling nonstop and it's just a blur because it seems like you've been at this event before type feeling. And so to keep things interesting for myself, I'm doing 100 tax expert interviews with CPAs and tax experts. And I've done about 20 of those interviews so far. And it's really grown my tax expertise. And I think, as I get to 100, I'm hoping to be sharing that with investors and improving my own protection of income. So it's just been a personal initiative to get a lot smarter on how to structure a gross revenue royalty deal and to get smarter on taxes this year.
Cool. Eddie, I liked one of the things that you said kind of hit home with me is like, we're in protection mode. Quest, I'm very blessed as a business owner. I have a lot of very intuitive, smart people from a lot of different backgrounds that just rolled right into it. I'm not sure I would know what to do, but I'll address. I'll be honest. Personally, I think I've been in protection mode when I started actually doing my own end of the year looking at, guess what? All my investments are paying off. And what am I doing? I'm too scared to get out there and get into another one. Is that really helping me? And I noticed other members of my whole family are the same way. We're sitting on a lot of cash. And I bet you that there's a lot of investors like myself out there. What are you doing? I mean, what are you changing to prepare?
Yeah, I'll answer that kind of a two-part piece here. I mean, business-wise, I'm still in efficiency mode. I wrote a curriculum a few years ago for all of my businesses called Empire, and it really identifies that each business is in one of 5 phases: a startup phase, perseverance phase, which is pre-profit, a profit phase, an expansion phase, or a succession phase. What I've noticed is that a lot of my businesses that were in either a profit phase or an expansion phase looking for that scale have now moved back into a perseverance phase where they're not necessarily truly profitable by all intensive purposes. Maybe breaking even, but not necessarily yielding a great profit. And so I'm still while I say I want to move out of survival mode, that doesn't mean that I'm not moving, that I'm still in a very efficient
You're not being
mode.
cautious.
Yeah, I'm still cautious and still efficient because many of my businesses are just not yielding the profit that they once did. And so many of them are, and we've made a lot of strategic moves. Personally, though, I think that the bold always win, and the bold always, have the greatest opportunities in life. And so in times of struggle and issues like we're seeing today, it's that person that has that bold tenacity to push forward. And so I find myself a little bit more in line with what Richard's doing, and that is I'm closing on more deals today than I have, in the past 2 years. I was heavy into multifamily syndication. I got heavy in about 3 or 4 years ago. And then I found over the past 18 months, 24 months, coming into COVID, that I was doing, for every, investment I made, I was doing 30 to 40. I was looking, due diligence on 30 to 40 of those multifamily deals, and they just had gotten too thin. The yields weren't right. The value adds were shaky. And so for me, now I'm seeing a lot of distressed opportunities coming back online. I've moved out of any hospitality investment. I've completely moved away from that. I really have shrugged off any commercial investment unless it's just a home run like what Richard described. But I'm looking heavy at big portfolios of single family. I mean, single family, the growth in the single family asset class has been amazing. And so for me, I'm looking at portfolios. I'm going hard after it. Now, I am keeping some powder dry, Nathan. For me, the greatest opportunities are still yet to come, and I can bring.
Yeah, I was waiting for you to say that, because I say there's some value to keeping some cash on hand right now as well.
Absolutely, and I think the greatest opportunities are yet to come. And I'm sure we're going to talk about that here in a little bit. But for me, I don't want to pass over the great deals that I'm seeing right now. But I also am very reluctant to jump into things that aren't just the home run deals right now. And so I'm keeping powder dry.
And every time I've seen it crash, there's always the first wave, and then there's always the second wave. And the second wave is usually the biggest or best buying opportunity. But again, this is not normal.
No.
There are pent up money. There is pent up deals. There is all types of stuff because of things, which kind of leads us into this next question, I guess. Let's switch this. Do you think the government will create another stimulus package? What about the extension on leniencies, rents, payments, evictions, mortgage relief, and so forth? Again, I think that's becomes almost a more local situation sometimes, and talked about because what's happening here in Texas is not the same thing that's happening in Arizona, which is certainly not the same thing that's happening in San Francisco. You know, anyone want to dive into that one first?
I think there'll be more stimulus, and then probably, eviction moratorium extended till June or September. But, the government and people, even outside of the White House staff, Fauci is saying that if you want to be vaccinated, you will be by summertime, whether it's early summer or late summer, even if the supply chain gets messed up. So I feel like there'll be a massive surge of travel at that point, and optimism when more stimulus comes out and Biden actually gives a speech on the 21st of January and vaccines are rolling out every 2 weeks from a new company. I think there'll be a ton of optimism, but I think it's going to be, obviously a really high death rate January, February, and maybe there will be another stock market drop. But with the vaccines and the stimulus potentially coming out, it seems like there's a lot of dry powder, like you said, and a lot of optimism on where things are going.
Yeah, I can tell you, I honestly don't know. I mean, when COVID first hit, we lost a lot of jobs here, high-end jobs in Houston, and I kind of live in an expensive neighborhood, thanks to my wife. And I really expected for my value of my house to go down, and just the opposite. It's gone up tremendously. We've had a lot of people move in from outside of areas, It's just weird. And anything that's a cheap house anywhere in the country, say under $250,000, is sold. Eddie? That's
sorry. So I agree. I think there will be a stimulus package. I think obviously the two paths of stimulus were, a similar path of the PPP going back to small businesses. It looks like with Biden potentially taking office, that it'll most likely go to the consumer. And so I believe that stimulus package is going to be aimed at the consumer. I think that'll happen somewhere at the end of first quarter. I feel, very similar to Richard, that, you're not going to realize that potential, that optimism, until probably summertime. I think it's going to feel great, but I think that the real potential from that optimism is probably going to be, after school's let out, and there's so many other economic drivers there. The interesting part about this is there's a couple, like I think it was Einstein that said that, any problem that had more than 5 variables is an unsolvable problem, and I feel like the problem we face today has more than 5 variables. But a couple of the variables that I think that we have to look at in the housing space is that, we were averaging about 50,000 foreclosures per month in March of 2020. So, right around 50,000 foreclosures per month nationally. Then in April, it dropped to 10,000, and we've averaged 10,000 per month from April until now. So you've got a pent up supply there of foreclosures.
In Texas, we haven't had a foreclosure in 9 months. All the courts are stopped.
Sure. So you've got, pundits are saying that there's anywhere from 320,000 to 500,000 foreclosures that should have taken place. And that's pent up supply right there. People are saying that we're underbuilt in the nation by about 1 million single family properties. There's a demand or a lack of supply of about 1 million. But then also, when you look at our job loss, 10.2% of people who lost their jobs in the last recession also lost their homes, 10.2%. And so I don't think it's going to be as great this time because of the stimulus packages, because of the moratoriums. However, Doug Duncan at Fannie Mae, the chief economist there, said that he thought that there's still going to be around 800,000 foreclosures that come because of job loss. So if you kind of combine the pent up supply that hasn't really hit the market yet, that traditionally would have just by average, and then you take the 800,000 that they're saying could potentially come on, that's about 1.1 or 1.2 million homes that should at some point hit the marketplace. Now, speed of how fast they hit the market, and all of those things, and whether they actually hit the consumer market or whether they're absorbed into bigger opportunities, whatever that is. But again, it's those variables that we're looking at. And so as much as we say it's going to be I'm highly optimistic, I don't know that I'm as optimistic as many people are, because I think that what's going to happen is more of an evening out and a steady rise. I don't think they're going to see this massive boom ahead of us. I think that all of these variables converging on one another is going to cause a consistent rise, but I don't see these massive ups or downs in the next 12 to 18 months. The potential there is obviously a big down if the economy begins to shut down or something like that because of a rise in fatalities or something like that. But again, it's all those variables you're trying to take into place. But I think the consistent is either side of the aisle, we're probably going to see stimulus. Either side of the aisle, if the virus continues, we're probably going to see moratoriums extended. I think there's some consistency there.
Richard, anything you want to add?
Yeah, I think I just add that it's tough on a panel like this to make these generalized statements, because like we're looking at doing due diligence on a walk-in. It's like a dermatology chain. There's a chain of 5 Botox centers that reached out to us recently as a manufacturing company. We own 18% of a bath salt company. These companies are all doing very well. So on the micro level, some people, if they deal with the cloud and digitization of an industry, they're doing exceedingly well. And then in some cities like Scottsdale and many places in Texas, you're doing very, very well. And it's a totally different story in the same industry, different location, or same industry, but different business model. And so I really think the results are highly bifurcated. There's obviously going to be some people in the middle, but I think some people are going to be extremely optimistic and moving as fast as they can. And we're trying to be part of that camp. We were used to doing tons of live events, and then we got caught not being able to do any. And so we said, how do we be part of that side of the fence where things are going exceedingly well? And how do we double down on everything that is cloud, digital, online based, et cetera, healthcare? And so I really think, you can participate in areas that are doing poorly, or you can decide to focus your energy on the areas that are very optimistic. And I think that's the challenging part about answering some of the blanket questions, because it's so different based on geography, business model, industry.
That's a really great point. It's like you look at these areas that are being affected the most, the Orlandos, Las Vegas, New York City. I mean, obviously they're going to feel very different than Atlanta, where I live, like the north side of Atlanta, very opportunistic, very, Houston, Scottsdale. I mean, it's like the ones you've mentioned. And so it really does, we're trying to answer these very broad and generally speaking, but that doesn't necessarily mean that it's going to hit specifically where everyone lives, or even potentially where we personally live.
Okay, I'm going to move into the next question, though. I think it's kind of sort of been a little bit answered, but we'll let you say, with low interest rates, are we seeing a spike in home purchases? How is this balanced with many Americans having been negatively impacted by jobs, being furloughed, hours, cut pay, etc.?
You want to take that one, Eddie?
Sure. Yeah, I'd be happy to. I think that in the end, people as a whole value their house more than any other asset they have. And what I've noticed is, the massive amounts of refinancing that has gone on and even continues today. One of the guys I'm here camping with is writing 40% more loans per month than he was, 6 months ago. And I think what's happening is in the beginning, when the stimulus package first hit, you saw a surge in new car purchases. However, new car purchases since June have tanked. I mean, like, you're seeing these bigger purchases begin to slow down. I know that consumer spending right now is very slow for the Christmas holiday season. The online sales, are way up, but they're compensated by the in-person sale that's way down, extremely low. And so I think what's happening is, I think the American economy, people as a whole, and again, this is a very general broad stroke, but as a whole, I think people are tightening their belts. They're not spending what they were spending. They're preparing for winter. They're trying to make sure that they can afford the house that they live in. They're taking every precaution that they can. Not everyone, but I think in large part they are. And so I think what's going to happen is you're going to see a lot of people that 2 years ago were planning on upgrading, buying their vacation home, doing all these extracurricular activities. Today, I think they're focused on making sure that they're renovating the house they live in, that they make it a place where they enjoy living. They've refinanced it. It's the cheapest capital they've ever had in their lifetime. And I think that that's what you're going to see. I think you're going to see a lot of new home ownership take place, but I think a lot of people that are stable and steady are just going to stay put. I don't see a lot of people going out and buying vacation homes and these ancillary properties that they don't need over the next year or two. So that's kind of my take on.
So it's a good time to find some of those proprities. I've heard that there's going to be buying opportunities in places that there haven't been buying opportunities for years. Maybe San Diego, New York,
sure,
San Francisco. Vacation areas maybe tanking. Is it time to buy? Anyway, just things. Richard.
Yeah, I agree with Eddie and what he's saying about kind of the masses. I think for a lot of people here listening as an investor, and for a lot of people we serve, they've seen such an increase in their single family home value in the stock market that I think it almost creates a little bit of a problem. Like if you talk to investors from Hong Kong or Singapore that own a bunch of real estate, for example, they're all used to getting 17% a year returns just by holding on real estate. And I almost feel like there's a little bit of that going on, that people got such a good return from the stock market this year if they got in and out at nice times in Q1, and so much of a return on their single family portfolio, they're a little bit spoiled in terms of the expectations now that they have on other investments they look at. And so we've been addressing that by making things very tax efficient, very income focused. So you're getting monthly wire transfers from investments you do. That we help structure. But I do think that that's a little bit of a challenge just psychologically for the people that are sitting on lots of cash and have been trying to look for the best deals. They don't know who to trust, or what's a high conviction deal, or the right team, or the sleep at night type asset. And so I think that it creates a little bit of a short-term challenge just when people have gotten a 90% return on their United Airlines stock, or whatever it may be that they went into in March. I think it's hard for a normal, sane, not risky investment to compete with some of the results people have gotten this year.
All right. Here, we'll move on. Do you think interest rates are going up? Inflation. If so, what should we be doing about it?
I think interest rates are going to stay the same. I think that inflation has gone up and will continue to go up. Ray Dalio said that cash is trash. He said, if you're sitting on cash, you're losing 5 to 7% of it, every year. And so you have to allocate that to things which will inflate with value as money is printed like never before, because cash is rapidly being devalued. So I do think that it's good for people to have a plan going into 2021 on how they are going to be allocating into the market. I went 100% to cash on February 28th. We then went to 25% invested through March and early April. And right now I'm probably 80% and 85% invested, and only holding on to about 15% cash myself.
Eddie?
Yeah, I'm very similar. With the Federal Reserve printing money like never before, inflation is inevitable, and I think interest rates eventually have to rise. I think there's an inevitability there as well. I just don't think that our government and our economy can sustain it. And so I think it's going to sustain that, that position we're in right now. I suspect that if our economy begins to move rapidly in a positive direction, within that next quarter, you'll see at least a small percentage raise of interest rates. And I obviously, that if you kind of play it out just, anecdotally, does that happen next year? Maybe. If it does, maybe it happens in fourth quarter. But the reality of it is it probably doesn't happen until the following year after they understand how the economy levels out, into the situation that they've never seen before. for. And so I think that they have to, I think they're going to sit there and kind of watch it as a test case and then react accordingly. But, with inflation, and obviously the Federal Reserve being an inflation, a mechanism to help our economy with inflation, obviously they should be preparing for it by increasing interest rates. However, they don't have the ability to even increase interest rates to even offset the inflation that's coming. I mean, the reality of it is like Richard said, I mean, you're losing, probably minimum 7% on that dollar. And that's a dangerous thing, so if your investments are not offsetting those losses, your cash is doing nothing but losing. And so I'm in the same boat. I'm trying to hold on to enough cash to be prudent for whatever days are ahead, but yet trying to invest every dollar I have outside of that amount that I've decided is prudent for my family and my companies and so on and so forth.
Which kind of leads us right into the next question is, when and what should we be buying right now? With fear of inflation and everything, should I just be like throwing caution to the wind and buying up every rental property I can? Should I, what should I be doing?
I mean, for myself, I always guide investors not to throw darts and feel like you're just running after every opportunity, especially if you're not seeing very many deals. You need to slow down even more. People might feel like, well, I don't see many opportunities, so I better allocate to both of these things in front of me. It's the exact opposite approach. Until you're seeing enough deal flow or you're connected to someone who sees a lot of deal flow, the deal flow you're seeing is for sure horrible. And you're probably going to lose your money or just do mediocre at best. And so it's important that investors look at how you created your wealth, what's your strengths, what's your expertise, where could you step in and actually take control as CEO or chairman of a company if you had to, or add strategic value. And look at your portfolio and how you want each part of it to function, your public market part, your real estate assets, and then your operating business investments, which should probably be managed by different brains or have different strategies and different functions to them. And I think that with myself, to narrow our scope and gain expertise faster, what we've decided is that on real estate, we will only be acquiring multifamily only in Scottsdale. That way our expertise grows in that niche area better when it comes to cash flow and real estate. And on the operating business side, we've developed some structures that we focus on, and we're more heavy weighted on healthcare than non-healthcare in the operating business side. But if somebody is still sitting on all cash during this whole time, then it's a little bit, too bad that you didn't already put some investments to work. But I honestly think that there's going to be a lot of opportunity through the whole month of February into March. And so I would not rush just to put money to work, but I would figure out how do you get access to a lot of deal flow, quality deal flow, and then find the right team with a track record and some group that you can trust and have high conviction, like sleep at night comfortability with, and start allocating. So if you're going from 100% cash, maybe you can get 25% allocated in the first quarter or 33%, but not at the expense of just throwing caution to the wind, of course. I for sure would do that.
Eddie?
That's great advice. I mean, I love the fact that you're investing in Scottsdale in your backyard. I mean, I think that's ultimately probably the greatest hedge against of casualties in the real estate space for sure, is to at least be able to get to that property, have eyes on it, build an infrastructure to support it. I'm a real estate guy. I come from, I think I'm fourth generation real estate investor in my family. Real estate to me is always the safe bet. However, I think that now as truly these asset classes have emerged over the past 10 years that are very specific, I would be very cautious in the multifamily space, because we haven't seen how these eviction moratoriums are going to play out. A lot of the multifamily that I am currently in, when we were used to 96, 97% rent collects, now we're in the 80s. I've got partners in those that are getting antsy and wanting out. I'm wanting to buy more of those assets. It's like, I think it's gonna play out over time. but I wouldn't jump at those deals if they're in a distressed situation. I think I would understand how you're going to reperform those, because creating reperformance is ultimately going to say that you're going to deal with those that aren't currently paying their rents. Well, there is no absolute in when they're going to have to pay their rents, and so there's a danger there. If they're underperforming, they may underperform for a while. So the multifamily space, I think there's going to be tons of opportunities. So I think there's going to be a lot of distressed, assets coming online, but I'd be very careful. Single family is a pretty safe bet right now, but I like Richard. If it's not something that you're already currently doing, I don't know that I would just rush into it. I mean, I understand it clearly, but by virtue of the question, I mean, we're supposing that we need to create some sort of hedge against inflation by investing our capital. And I think that your greatest returns right now are typically in the single family space, if you can buy right now. If you're a little bit more savvy, like Richard is, in the healthcare space. I mean, there's tons of industries that are just exploding right now. I've been looking at a bunch of syndications on warehousing, because warehousing right now
I've heard
is
a lot
at an
about
all-time.
the last 30 days.
Yeah, in Atlanta, where I live, I mean, you've got 2 new Amazon, hubs. You've got massive. It's the center for commerce and e-commerce distribution in the South, and so those are pretty safe bets. However, I've never been in the warehousing space, so I'm walking very gingerly into it. Making sure that I understand it, talking to everyone I know that's in it. Getting in as an LP versus ever taking a position as a GP in any of those deals to kind of understand it and kind of put my toe in the water. But I think there's going to be tons of opportunities. I think that, it's interesting. I just read Airbnb put out that, last year, obviously they've got kind of a probably inflated understanding of what the returns are on the assets. But they said last year that the average return on an Airbnb property in the nation was around 7.2%, which seems a little low, but probably pretty traditional in the short-term housing space. This year it's expected to be closer to 9%. So you're seeing a 2% increase in returns in short term. That's an interesting development, because I think there were people that in May and June that thought that short term was dead, like it's going away. I certainly began to be cautious until someone called and rented my Florida house that I just want to live there and I'll pay your your standard rate for the next 6 months. And I was like, okay, maybe we're onto something. But I just think there's going to be tons of opportunity, but I think it is going to be centralized to where you live. I think it's going to be centralized to what you know. And I don't know that I would jump into something that I have no education or experience on in this time period. One last thing is the stock market. I mean, in the end, if you are highly vested in the stock market, and I'm not a financial advisor and certainly can't give financial advice, but I'm being very cautious on the market, knowing that there are probably days ahead where there's going to be more opportunity. And so the way that
like leads me right into my next question. So I'm going to throw it up there and then let you keep going and answer it. Okay. Which is, hey, if I'm invested in the stock market, is it a good time to switch back to real estate, open an account at Quest, move money in and buy real estate? I would have to say yes to that, being the president of Quest.
Yeah.
But what would you say, guys?
I think it's a perfect time. I mean, I think that the market's volatile ahead of us. I think there are going to be opportunities in the market, but I think that the market has to decrease before the true opportunities come. And so I definitely don't want someone else to capitalize on my loss. I want to capitalize on some other potential loss there. But yeah, I think it's the perfect time to move towards real estate. It's a stable asset class. I think it can hedge against the market's volatility.
Right. Yeah. I mean, I think the market might go higher from more stimulus and vaccine news coming out, but also there could be many things that could make it go lower. So personally, taking 25 or 33% off the market and keeping some in there in case it continues to ride. And then as it reaches all new levels, maybe taking some more off is a type of approach I would take. I find that most people would like to be investing more in real estate or operating businesses, and they have trouble sourcing the deals, and they don't know who to trust. They don't know how to get started. They don't know how much to invest the first time. They're having a hard time going to visit properties or meet with people right now. And so I think that is holding people back more so than knowing what the right timing is really how to do it and who to do it through, I found.
Well, I think we talked about this a little bit, but I think it's a good question here. So let's hit it again. Is there certain areas of the country that are stronger with investment opportunities? Are there areas or markets, that we need to avoid coming up?
Well, I mean, obviously it's so obvious that, Texas, Florida, Nevada, Arizona, Atlanta's been doing well, and so obvious that New York and California have been hurt that it's almost like, there's some momentum there, but whenever it's so obvious there's momentum and it's been on the front page of the Wall Street Journal for 6 months, you also have to think to yourself,
are we at the top?
Yeah, what's the next thing that's going to come? And also, where is there that genuine, steady, long-term demand, not just a short-term surge? And like you said, maybe where are there opportunities created? Because everybody says, yeah, New York is trash. Get out of New York. Get out of New York. Is there an opportunity there using expertise you have? Or are you catching a falling knife and you're going to get hurt by it? But some little cities that have been coming up more often than they should be is like Huntsville, Alabama. No one ever talked about that city more than a year ago in my world. Jacksonville, Tampa have been coming up a bit more. And then, people are just hearing Texas all the time,
It's hard to find a deal here, I think. It just sells really quickly or things. Eddie?
Yeah, I think it's really, really difficult because the areas that probably have the greatest opportunity are, again, the ones that are going through the greatest loss. Like I mentioned earlier, Orlando, Las Vegas, New York City, San Francisco, Chicago. Chicago is struggling, economically. And so, it's hard to tell because as real estate investors, we're opportunistic, like we typically look for those opportunities. And so in the areas that most people are running out of, we're typically running into. How many people have I heard talk about buying property in Gary, Indiana over the past 5 years? Nobody wants to live in Gary, but yet real estate investors are there propping up the market, So I don't know. I think the greatest opportunities are going to be the ones that have the greatest job loss. And over the past 6 to 9 months, and that creates the biggest issue with housing. And I think that the opportunities are going to be there. You've got so many economic drivers in like a city like Orlando that's the central part of a growing state that's between some amazing markets there, between Miami and Boca Raton is growing still like crazy, and Tampa. And it's the central piece to all of that. I just can't see how Orlando is going to have a sustained decline. I think that Orlando, even with all of the economic depression that they're feeling, still has enough economic drivers and proximity to other great markets that you're going to see Orlando just continue to thrive. So I think markets like that, markets like Vegas, where really the only thing they have going is tourism, maybe I would stay away from for a while until it begins to return. But Orlando is such an economic hub. They're going through a depression right now, but in the end, I think that they'll have a quick surge. So that's my take on the markets. But yeah, and there's so many great little tertiary markets, like he was saying, like Huntsville, and I've heard so many like Boise, Idaho, and these great markets that are emerging that as people begin to work remotely and find their place and go back home, maybe where they grew up, and college took them away from these little small tertiary towns, and now they're going back with all their degrees and experience. It's creating a pretty diverse economic situation across the entire country.
Okay, let's go on to the next one. Here we go. With all the foreclosures out there, widespread throughout the country due to the mortgage forbearances, do you think that there'll be opportunities that arise, or what's going to happen as these open up. I know in Texas, I have a hard time predicting it even as it opens up, because I got a little bit of at least in this Houston and Dallas County, our large cities. We had Texas, as most people know, has typically been Republican. In those large cities, we had a large Democratic sweep in the last two elections. And what happened is we lost a lot of long-term judges that were very experienced in these small courts, and they've been replaced. And the new judges aren't very efficient. And so even the cases that are coming up, they haven't really figured out how to trim through them. And then we have all this stuff that's backlogged. We're not sure how long it's going to take, especially running with new horses in there, right? How long it's going to take to actually be able to even get through it all. We may be playing catch up for years here. What do you guys think?
Right. I expect the first wave of, I'm more focused on the commercial foreclosures. I think the first wave of those will be coming through in February and March. It takes a while to get through that process and give people some time to catch up on payments, et cetera. But yeah, not until late Q4 next year probably will a lot of these things come out. And I feel like based on the demand, like that Eddie referred to, there's big institutions that will probably line up next to banks and say, hey, we'll take 80% of these homes you just foreclosed on and give the garbage ones to your one-off high net worth investors, or for big banks. For small regional banks, they might foreclose on stuff and still be a good property, but there's so much institutional capital chasing these single family homes that you wonder what types of deals are being made in back rooms just to pick up 30,000 or 50,000 homes here and there between some of the big banks and these institutional funds.
Yeah, I could speak to that directly. If there is 1.1, 1.2 million homes that come online through foreclosure, that's still only a third of what we experienced. I think we had 3.2 million come in foreclosure between 2007 and 2010. So you're still at a third of what we experienced back then. But Nathan, I think you're right. The speed of processing is going to be an issue. However, I really believe, and I know of 4 major hedge funds right now that are already cutting backroom deals. One specifically that, I sat on their board for a while, that has inroads with JP Morgan Chase. And we believe that JP Morgan Chase and Wells Fargo will probably have 50% of those foreclosures. The interesting thing is JP Morgan Chase at the beginning of the pandemic laid off 300 lawyers that they were using specifically for evictions. For foreclosures. And so 300 lawyers they laid off, and they've only hired back about 50 of them. And so
someone's got to do the work. There's actual work involved with foreclosures.
There's a lot of work, and the banks aren't even poised right now to take advantage of those opportunities. So what I believe they're going to do is they're going to sell these for pennies on the dollar, realize the insurance value of those properties. They're going to understand how to hedge their bets better this time than they did last. And they don't need these properties to go all the way back to the consumer marketplace for them to make a yield on them. They're going to find opportunity in selling them in big swaths to these big hedge funds. One of the hedge funds that, I was a part of, they're wanting to take somewhere in the neighborhood of 250,000 to 300,000 properties out of the market immediately. And they have the capital to do so. So it's going to be interesting to watch how that plays out. But I think, it's interesting because I really don't think that the small mom and pop real estate investor that's waiting on this foreclosure market to just explode and go crazy, I really don't think that that's where they're going to find their opportunity. I've been pushing hard to the Think Realty membership that if they're a small mom and pop real estate investor, they need to be looking at subject to deals and opportunities where someone already knows they're in distress, knows they're not going to be able to keep their house, and would like to prevent going through that process. And they could find those opportunities now. They could be marketing directly to those people in distress situations, speaking directly to them, and provide them solutions long before the bank ever has the chance. And that's the true opportunity that I see coming in first and second quarter next year. Because I don't believe that any of these foreclosures really, number one, will actually hit until fourth quarter or 2022. And if they actually do hit, they're going to be in small quantities because the bigger players are already ready. Their dollars are aggregated and they're ready to gobble them up as soon as they're available.
Okay. Let's move on to this one. All right. How about this? What about if I'm looking to raise private money? All these investments coming up, right? All this good stuff. What do you give to advice to people that might want to try to, tap into some of that private money in order to find a deal or something? Where will we find private lenders this year? I know if you ask Haley, she would say come to her networking event next Wednesday and you'll find them. But what do you guys say?
I would say to see where, based on what city you're in, there might be certain pockets of wealth or known areas and clubs and organizations you could be involved in. Also, if you're from a certain industry, like you used to be a dentist, then I would go there and you'll have things in common with those people. I would also laser focus. When you're a small firm, it's not credible to say, hey, we cover 6 different states and 3 types of assets. Like that just means you're doing a horrible job probably on doing so. So saying, hey, we only invest in these 4 blocks and we know the owner through county records of every single person on that asset and we know the valuation and we can, drive there same day and we can close in cash fast and all of those advantages you get with a laser focus, I think makes things much more credible. And then I would also do a lot of research on how to structure a deal to make it either income focused or very tax efficient or just a very aligned structure for the investor so they feel like your fees earned are when they do very well, and your fees earned are not just when you tie up their capital and you have acquisition fees and closing fees and asset management fees and 19 different types of fees that you get whether you did well for that investor or not.
Yeah, I think there's a lot of capital sitting out there. But in my experience, capital follows deals and follows experience. And if you're raising capital, I think Richard, probably typically plays more on the institutional side, being tied to family offices. For me, a lot of the investment capital that come through my network is more in the form of syndication. A lot of my guys are dabbling in funds, but still are primarily focused on syndication. And, the deal is still of the utmost importance. And if you can speak towards it intelligently and conservatively, I think that people want a conservative voice and they need to feel secure in the investment. And the reason that they feel secure is because you have experience. You're not just jumping into some new deal that you've never been a part of before. And I find it to be actually easier today to raise capital than ever before. There's so much capital just sitting there ready to be deployed. I think there's an urgency that most people understand. Nathan, I don't know about you. I've spoken to a lot of the companies that have self-directed IRA custodians, and there's so much capital in kind of in that network that's just sitting on the sidelines waiting to be deployed. But again, I think it comes down to the deal and to the experience. I can give you
a firm figure of $387 million sitting at Quest, earning 0% interest, just sitting there waiting to be funded. And what's interesting about that is money's been moving in all different directions. People have taken money out. People have transferred money over to stockbrokers as a thing. But I also have large groups of people who are now moving a lot of money into self-direction, and they're looking for passive style investments, either being a hard lender, which is typically what I do, or, I don't like toilets and tenants, though it pays really well. I don't like to work. I'm lazy. But, so I think that is true. What do you think, Rick?
I think it would be pretty cool, though, to watch you clean a toilet in a bow tie. I think that'd be quite.
I've probably done it.
It's a statement, I
love the next one. If I'm looking to use my IRA as a private lender, what types of things should I be looking at when determining how to fund my loan? I could make a whole show over this question for me because I've been a private lender for a lot of time. So I have certain things I always look at. What do you guys look at? Do you use your IRAs to lend? Do you use your IRAs to borrow? How do you do? What would you say to a person that wants to do it, that's never done it before, maybe?
I mean, I wrote down a big list of things. We've got a 100-point due diligence checklist that we refer to when we're looking at deals. But obviously, looking at the credit, how much you trust them, who's on their team, their process, the valuation of the asset, basically the location, the LTV. Are you first lien or not? What types of fees you'd be paying, or what the points are on the deal. Is there alignment in the deal? I think there's a whole lot of things to look at. And like you said, it could be a full day workshop, and people do full day workshops. And I know, Eddie, you do events that, have 30 experts on stage, I think, talking about these types of strategies. So hard to say in a sentence or two, but most of the time I feel like when people don't understand how the value is added, or it's not very clear how the value is added, then it is don't want to invest. And so I think the most important thing is just to be able to trust the team and the process and see that value creation process and be very comfortable with understanding the mechanics of that. And then people lean forward and they get much more comfortable with, getting the deal done.
Eddie?
Yeah, I don't know that I would add, too much to that. And I lend out of my IRA. I do a lot of, interesting things in and out of my IRA and help my mom with her IRA and so on and so forth. But yeah, for the most part, it's all about due diligence. It's all about understanding the liability that's being created by extending capital. And then, maybe secondly, I don't know if you're familiar with the program called Real Numbers, but understanding what my rate of return is, my true rate of return, when I get a bunch of deals going on in my IRA, I think many people look to the custodian to try to help them, understand what's really going on, what the return is, but actually using maybe some sort of a subsidiary source to understand where all my deals are, what the return is, and keeping all of that in one place. Because, once that thing starts to grow and you get 10 or 15 deals all going on at the same time, like understanding where all it is and, what the actual returns are and when things are due is really important.
Yeah, I think that's, unlike you, it's hard to say it in one sentence, or a couple of sentences, but I would definitely say a couple of things. I would say probably the most important thing to do is know what to do if it goes wrong. If you're going to be a lender, right, each state has different processes and takes different amounts of time. You should, be very familiar with the process of what to do when it goes wrong, be willing to go through that, right? And know that about yourself, right? If that's too much of an onerous process, you better have a separate exit strategy or something else. Don't loan on something that you don't want to have to foreclose on, right? And hopefully you do all the due diligence to hedge that from happening, but you also should do all the things to protect yourself, like make sure that the attorney that's drafting up the documents, is on your side. You know what I mean? That's a good one, and that those documents are not going to force you into a judicial foreclosure if you're in a deed of trust state or something like that. I would also say you got to pay attention to the location, right? If you don't have any boots in ground in Gary, Indiana, you might have a hard time when it comes time to foreclosing or something, So we have a whole bunch of classes online about, I got some little rules that I made up that I do before ever I lend to somebody, and you can watch those classes. You guys all have education on your sites too about this exact topic, right? So,
but you're the expert, so I would defer to you. I mean, this is your world, and I would say, Quest, I've been on your site and seen all that you guys provide, and would definitely recommend it.
Yeah, I was honestly going to say that, and I'm not just tooting on the horn, but one of the first things you do is pick up the phone, talk to an IRA specialist. Our education's free. And make sure you understand the process. Make sure that you're comfortable with it. Pick their brains. They're not on any side of the fence. They're not getting paid a commission to know. Anyway, they're highly educated and know what to do, and they don't have a horse in the race. If you get what I'm saying. So that's really great when you can have an expert. Because often, if you're talking to somebody about your retirement and they're an expert, they're a certified IRA specialist. Well, the decision you make directly affects their paycheck, right? So that could affect the advice they give you. It shouldn't, but it often and could. which is not going to be the case in a self-directed thing. We're always going to be a neutral third party, and so you get a chance to talk to these highly educated people that aren't trying to push you or sell you any way or another. Oh Lord, I got to pull up my next question. I lost that here. Out of all asset classes, real estate, notes, private equity, commercial, etc., which class do you think you see the strongest opportunities in 2021? Which asset class do you continue to struggle? Are there hidden opportunities here for the class? It seems like what we've been talking about the whole time almost. But I mean, are there hidden opportunities? Which asset classes out of real estate and all those is going to do the best? I guess if I were to answer it, I would say, it's like the adult diaper. It depends. It depends on where you are and what the asset class is and so forth. Because to just throw a blanket over it and say all commercial property is going to suck next year, clearly isn't happening. There's a lot of opportunities, like you said, and niche areas like small warehouses that are, the backup or servicing, not the giant Amazon warehouses that we all know are being built, but the smaller ones that if you get the opportunities, things like that. Self-storage, I heard, could do really well over this next year. There's other types of opportunities. What do you think, guys? You want to start, Richard?
Sure. I mean, I think starting in August, you're going to see a travel bonanza, and everyone's going to be like, "Thank God we're not stuck in our homes anymore."
Oh my God, I know I am.
I think that that's if you're going to clear out, half of your stocks in the public market, maybe don't clear out all of the travel ones or ones that would rebound. If things are already crazy high, like a Costco, Amazon, Tesla stock, everyone loves those stocks and thinks they're probably going to go higher and higher, but they're already so high compared to some of the travel related stocks. I would just say that the travel is going to surge, I think, late summer and fall. I've also found a lot of optimism and progress within the area of investing in dental clinics. We just signed an agreement to invest in a dental clinic yesterday, and we're looking to invest in several more dental clinics. We're also looking at some medical spas and other medical healthcare businesses. But in general, dental clinics have not really been affected poorly, and they sell at great multiples. So we've just been they're good, consistent tenants for real estate if you own the real estate underneath them. And in general, they're good businesses to consider investing in compared to like a restaurant, which is so exciting to say, hey, I want to come to this restaurant I own. But most restaurants, even before the pandemic, failed. It's a very tough business to be in. So I just think that's an area that's overlooked by a lot of investors.
Yeah, I would concur. I think everyone today, most economists are talking about these micro sects, like these little tiny, pieces of an actual asset class, so you take the co-working space, like they're kind of dissecting that down as like a micro class. I don't know that I would touch co-working spaces for a while. However, we're starting to see resurgence of co-working in more outer lying areas, where the big WeWorks are still suffering in the downtown, metropolitan areas, in suburbia, these little 14 to 20 seat small, co-working spaces are surviving. So again, it's these little micro classes that are doing well, and it's just understanding your own market. I think single family is always a pretty safe bet. I mean, in the end, it's the one thing that everyone needs. They all need a roof over their head. And I think that it's a pretty safe bet. I think the appreciation of the market is still looking positive. I think you can still win in both yield and appreciation. Again, single family is just a little bit, you have to have an infrastructure for it. If you don't want to do tenants and toilets, like, Nathan, I don't either. And I'm a passive investor. And,
I'm just
yeah, but if there's some great turnkey providers or something like that you can get involved with, and, I still see, north of 15, 17% on turnkey properties that I buy. So, and never touch them, never worry about them. I just, buy them in very specific areas. But again, I'm always looking to leverage the assets I have to go buy more. I very much buy into the leverage methodology, and And so I'm always looking for things that appreciate as well as yield. And sometimes I'll give up on my yield if my appreciation looks really good, because I know that I can potentially leverage that piece of that asset in the next 4 or 5 years potentially and gain more, and then my value.
I mean, that's so true. I mean, I'm a lender my whole life, and I can tell you that I lose opportunities because I don't hold enough stuff. You know, I'm always chasing a yield.
Yeah.
But again, I would give the argument to that is that I'm also running Quest. You know what I mean? I have a full-time job.
Yeah.
And I think that a big mistake a lot of people make, and that I've made too, and probably both of you, is not thinking enough about how long it takes to manage the investment, right? And picking investments that work with your lifestyle.
Sure.
Right. My lifestyle today is certainly not the same lifestyle it was when I was 30 or 40 or, even 50, So I want different things. I love one of the big things that I love that you brought up that I've been meaning to think, that is that you talked about different stages of business. Most people go through business not knowing what stage they're in. And if you have a long-term successful business, and I think I do, I honestly do. I think that I've beat those stages. I would say I'm at the last stage, which is what I call legacy. You're trying to create it. So it's creating legacy for your employees and things that go on, but I think that was very intelligent to talk about that, as to knowing where you're at and knowing that it's okay sometimes to take a step back, as long as you know why you're doing it and what you're doing. You're going to go back a step to rebuild, to be able to and most companies who grow into big companies understand where they are and how they're doing. I'm kind of getting away from the questions, but you said that a long time ago, and I thought that was pretty intelligent.
To put a bow on it, I think as a whole, if you don't know where you are and where you're potentially going, then typically we're just putting dots on a map and we're aiming for it and going for it. There's too many seminars out there that are teaching people 10x your life, 10x your business, 10x your marriage, and all this stuff. And I don't want to necessarily cast dispersion towards that, but the reality of it is there are some times that you should not 10x your business. Like there are times that you should create sustainability in your business and understand its profitability. Just throwing people or technology to business doesn't ensure its success. Sometimes it ensures its demise. But the thing is that
I think you have to have an insight as to what you want long term.
But I think that goes into to draw that back to what we're talking about here, is that most people are just looking for the opportunity. They're opportunistic, so they're just going to go after it. However, I've seen a lot of people switch asset classes because of the new opportunity, and then lose their shirt because they weren't set up. They didn't have an infrastructure to try to help them manage that. A lot of my friends went from, I obviously, because I have Think Realty and the people that I run with and my friends are all real estate investors. And then I watched about 4 years ago when they couldn't find the deals, they all got into fund management. Well, I can't tell you how poor some of them were at fund management. Like they could raise the money. They had the deals that they could pour the funds into. But when they all of a sudden had this discretionary amount of capital that they never had before, they felt invincible and began to make decisions that they never would have made with their own capital. And, so just because you're good at one asset class doesn't mean you're good at another. So there's got to be some caution there as well, even though it may be the greatest opportunity, understanding where you're potentially wanting to go and what it's going to take to get there.
Changes. Me and my brother did a lot of investing over the years into small, inexpensive properties in Mississippi and these type of areas. Joint ventures, limited partners. Some of these were $18,000 houses, $25,000 houses. The return on them is phenomenal. Here's the problem. At having 150 of them all of a sudden, you're old, you're running a company. Now I'm having to literally hire full-time, very intelligent people to help me manage all the different payment schedules that have taken place and trying to wind them down because I actually got too many of those type of investments. At some time back, I should have been thinking of maybe lower returning investments that had a lower work input to them. That's just a problem I made. But I mean, I think there's all types of problems like that occur. You have to change not only according to environment, but according to you. Your life changes as it goes too. Richard?
Right. Yeah, for sure. I think one of my mentors has been Dan Sullivan, and he talks about this concept of unique ability, what you're really excellent at and passionate about and stuff you enjoy doing. And he's really taught me a lot over the last couple of years. So I've really been focused on investments that use my unique ability and our team's capabilities most, so that it's not a huge amount of effort to add the value as a board member or being on the cap table and adding value in some strategic way. And I found that's been super helpful in deciding what new business division to launch or what to invest in or how to structure an investment.
Yeah, it looks like we might have temporarily lost Eddie. He'll probably come back. He's
Sure.
out there. He's out there in the Arizona deserts without the best internet. But yeah, I mean, I don't know, man. I think that there's going to be a lot of opportunities, but it's going to be hard for a lot of us to be able to point to them. And I think that we do have to look at the work that you want to put into it and what you want out of it, and sometimes what you need out of it, right? Again, It might be better if you're really honest with yourself as I'm looking for more time, and maybe the more money isn't as important to me. Maybe I need to make sure I have my partners or people that I'm choosing, to think that way.
Right.
Because I think as you get older, that becomes a truth.
Right. Or it could be they might value more steady income, less risk in the investment, and a more moderate return. And they can sleep at night knowing, okay, things are going to be fine, and I don't have to worry about it going to zero. It's very unlikely it would go to zero and be a binary result. For me, I'm relatively conservative. And so even though we have lots of angel investors and small private investors in the family office club, the only deals I spend time on through privateequity.com is really the very conservative deals, things that are cash flowing, things that are steady, things that have already proven themselves, just because there's so many investments out there that are highly risky. And if you go to an investor club, most investor clubs are angel investor focused, which means that some guy with a new widget or a new piece of software who's promising to change the world, but it's also very likely your money's just going to go to zero. And so we try to stay away from anything that's close to that, just because there's so many angel
I
investors.
wish I had the numbers here to tell you, but a lot of that startup stuff ends up, in a bad way. I get to see a lot of it, and it usually takes a few years for it to go bad too. But
yeah, I think there's about 19 different risks that a lot of private investors don't see when someone is starting a company. There's a risk the team can't work together, the pricing is wrong, the product doesn't work, or it's too competitive, or you're commoditized, or you can't execute, or the CEO's distracted. There's so many different risks that if you just wait till someone does $1 million in revenue and actually has a team and they've hired and fired and hired and fired and survive that and know how to actually make money and not just burn investor money, I think it just makes it much easier to structure an investment. So that's where we focus 100% of our time.
I know a lot of people say, well, geez, that's why I'm just going to stick with real estate. I'm just going to do real estate because that makes the most sense. You get appreciation and cash flow. But you get hurt there too if you don't do it right. That especially on rental properties, everyone said get rental properties, and that's probably pretty good advice. But again, make sure you have your structure in place, because a bad tenant can destroy one piece of rental property's profit for years, right? Getting them out, the damage that's done, getting it right, or buying in the wrong area or something of those.
Right. Yeah, for sure. I also think that a lot of people do like operating businesses and do want those different types of returns. And so I would just encourage people not to invest in 10 different industries. I would almost always put some capital in real estate. But when you decide to invest in operating businesses, I would only invest in an area where you made your money, or you have some strategic insights or advantage, or you say to yourself, hey, I really like healthcare, I really like dental, I really like stem cells, and you become very savvy on investing in that one area, whether or not you made your wealth there. The worst thing to do is invest in 20 different industries of operating businesses where you don't know what you're doing, because you'll be bad on due diligence, you won't be smart on valuation, You're not going to be able to add strategic value to make it go up and help stop it from going down. So I think knowing what your focus is going to be and, having that framework is really important as a private investor.
Rich, I'm going to get off the questions they have for me. I just want to ask this one because I know you know a lot about setting up to try to taxes. You know what I mean? Like right now, what should we be doing for taxes? What strategies might be good, and what's going to be most likely a rising tax market for a lot of us. Is there some things that we should be doing for the end of the year? Is there some things that we should be doing at the first of the year? Talk to me a little bit about taxes.
Right. So if you're a business owner, one thing you can't roll back the clock on is QBI based on how much you're paying yourself salary versus profit distributions. And if you get this wrong, you could be burning $50,000 a year in extra taxes paid. So I would just talk to an expert about your level of QBI and how to optimize that. But more importantly, there are opportunities to invest in things which give you a NOL, a net operating loss, and you can carry that loss back several years, or that are more commonly found a first year depreciation write-off. And so
can you give me an example of either or both of those for our viewers?
Sure. Yeah, so basically, if you're going to invest in, like one example we're working on right now is a dental clinic area, and they're doing tenant improvements on the piece of real estate. They might invest $800,000 on improving that piece of real estate. And that $800,000, if it's on equipment or tenant improvements, could be written off that first year. And so what that means is that if they invest $800,000 and they can write off $800,000, if you're taxed at 40%, that might save you $350,000 in actual tax savings that you would have paid the government. And so even though you put out $800,000, if you're saving $350,000, you're effectively only investing, $450,000. So think about the difference. If you invest $800,000 and you just get $1 million back, around a 20% return, okay, it's pretty boring. But if you invest $800,000 and got to write off $350,000, and you really only invested $450,000 and you got $1 million back, you doubled your money. It's not a 20% return; it's a 100% return. And there's many different things to know about this area, and you should definitely seek a CPA, a tax expert, before acting on anything, because I can't give general advice to 300 people on taxes, and I'm not a CPA. But like Haley said at the beginning of this, but one thing to know is that if you could get a piece of equipment for your business that costs $800,000 and you finance that through a bank or an equipment financing company, and now you put down $400,000 to acquire this $800,000 asset, and if you can write off that whole asset, what you've done now is captured a $800,000 tax write-off, and you only put down $400,000. And so now, sometimes the math is much better than that. You can get 66% financing on some things and get a write-off on the whole thing and put down less money than you got on the write-off of it. So I don't want to confuse people or get too deep into it. But
no, but I think even if you're confusing people, I think that you're hitting on some points that are really important. It's really fun to go to a real estate club and learn how to take, $10,000 and make it into $20,000, right? It's less fun to learn about the tax benefit and the tax strategies, but in the end, those are the things that are going to get you into the end zone. And so I think every year you should be spending time, especially at the end of the year and the beginning of the year. Let's look at the tax things that are going to change. Let's look at our IRAs and the regulations rules. Let's talk to our CPAs. Let's talk to our IRA specialist. Let's talk to, the investment specialist, and just have some brainstorming periods. If you're not doing that, I guarantee you're missing. Every year I miss something and I do that, right?
Oh yeah. Yeah. This is the number one area I'm investing my brain energy into. And I've already seen such a huge ROI on the value to add to clients and myself. And I would just say that your CPA that you use is probably just preparing your taxes and telling you how much you're owed. A normal CPA does not do very good proactive tax planning. You should for sure call Quest Trust and talk to an IRA specialist. figure out what you're missing on their side. I know I need to learn more about, health savings accounts, for example, but there's a whole laundry list of things to research. If you're in the manufacturing industry, looking at R&D tax credits could be something that could be hugely beneficial to you. I mentioned QBI, NOLs, net operating losses, depreciation, accelerated bonus 179 depreciation. I would also look into if you're managing a lot of real estate, or if your spouse is helping you manage real estate and you're a business owner, if you or your spouse can qualify and be designated under the eyes of the IRS as a real estate professional, that changes your tax treatment and your ability to depreciate assets that you're actively involved in across the board in many different ways. And the difference could be massive. It could be the difference of saving on one investment, on say a fourplex you buy with a partner. You might invest $400,000, and that partner might get coverage on $150,000 through an engineering study. They might get $150,000 of tax income sheltering because of their real estate professional designation and their scenario, versus you not getting any. And so looking into that is something worthwhile. And I just encourage people, if you're making more than $300,000 a year, or you're worth, a couple $1 million, then you're going to get a big ROI off of digging into this stuff and really becoming a student of it. And it gets more exciting once you actually see the results.
I got to task you. You got to learn your HSAs, your health savings account, Richard. I'm going to argue.
I wrote it down.
I'm going to argue going forward that having a health savings account as part of your portfolio is going to be as important as a Roth IRA. All right, because grows tax-free. And what is the number one thing that erodes most people's wealth? Healthcare.
Right.
It's a fact. It's sometimes it's not fun to talk about, but you should have Haley on. She's an HSA expert on your things and go through it. She's pretty smart on those type of things.
Be happy to interview her for that as part of that 100 interview series. That'd be awesome. We could probably have her on for a couple different topics.
Yeah. She really likes talking about HSA, so she'll be all over it. Great. Okay, I'm going to change gears a little bit. I'm not sure we're going to get Eddie back. They're still trying. Okay. So I'm going to try to talk about things that are a little bit more that I know you know a lot about, but let's talk about investor regulations. I mean, there are some possible things coming down the line that are going to be changed. There's going to be some things that we better put a stop to, I think, if we can, through some political pressure, if we can. But I guess the overall question is, what is the things that have changed and what is going to change, or may change over this next year that we need to be working for as far as regulation and legislation?
Right. I mean, the biggest thing I've been paying attention to is the potential tax legislation changes. But most recently, they've been adjusting the definition of an accredited investor and who can come into investments on investments that are usually restricted to accredited investors, but also they're expanding what can be done through crowdfunding and raising the limits on how much you can raise. So I think that these crowdfunding platforms are just going to continue to gain steam. If some of you have seen some of those out there, I think you're going to see growth in that. And then also I'd taken down a note on my sheets related to the taxes. I know that some people see everybody moving around to different states to save money on taxes. I also know that some people feel like it's sort of cheating and non-patriotic to pay $0 in taxes. I know several people that make, 2-3 million in profits a year and do pay $0 in taxes. So I just wanted to point out that if instead of moving to a different state, you could just add some knowledge to your brain, and as everyone else complains about taxes going up, your taxes are being cut in half. It doesn't have to be about paying zero taxes and either feeling guilty or not responsible by doing so, but you can get it zeroed into where you want to be. It could be a lot less painful than picking up your family and moving to a whole other state just to pay less taxes and not be near your family, not be near the weather you like or your past investments, et cetera. But on the regulation side, I think the most important thing coming up that people are talking about the most is the tax legislation. The Opportunity Zone bill was one of the biggest tax advantaged bills ever passed for investors. So people are watching anything that's going to change the treatment of dividend income from the stock market, 1031 changes, or opportunity zone, or just general tax rate changes are what my investors are talking about most often. They honestly don't even mention the crowdfunding changes typically, even though they're happening and they're relevant to the industry, of course.
There's been a lot of things that have happened this year that I think are very important that went unnoticed by a lot of people. And of course, I have the IRA filter, right? I'm looking at different accounts, so I look at it differently. But there has actually been one of the largest transference of wealth in world history that occurred in 2020. People don't even know it. Of course, which is money coming from qualified plans have now gone in more. There's more money in IRAs, and you say, well, what does that mean? Well, most of America's wealth is held into their retirement accounts. And so when you're looking, if you want to see the biggest bucket of money, you want to see retirement accounts. Well, while they were left in qualified plan, what happened in 2020 is a whole bunch of people are getting older, right? All of our baby boomers are retiring. Whole bunch of people took early retirement or other types of things. All this money has moved into IRAs, and a very small portion of that is self-directed. It just kind of takes you back to, there's all types of things going on. For those of you that are worried about raising money, the money's going to be there like it's never been. I got it. It's going to be, might be hard to find a deal, but cry me a river, right? Give me enough money to buy everything that you can get and make me work for the deals really good. But I mean, back to legislation stuff. What about like wholesaling? I heard wholesaling is going to get attacked, with some of the new legislation and things like that, and how is 1031 exchanges, if that goes away, those type of things going to affect us?
Yeah. I mean, we're not involved in wholesaling ourselves. I'm not very familiar with the changes going on there, but with 1031, I've just heard several family offices say that if that gets taken away, then the price of real estate is just going to go up because people are going to not sell their properties until something like it comes back and they can roll the property into something, or it's a better tax environment. If you raise taxes on the wealthy, they're going to work harder to move to Texas or Florida or Nevada or somewhere lower tax state-wise, but also they'll change their behavior to have less capital events. Like right now, family offices are encouraged to consider whether they should exit an asset in this year before tax treatment might go up, because maybe their tax rate is going to be greater if they sell that property next year, and they were deciding between this year and next year. So I think a lot of tax laws don't take into consideration that people like Elon Musk can just simply move and take their business elsewhere, or just not sell a property if federally they take.
Well, I mean, I know that I think that I would be more likely just to hang on to something and let it sit, especially if I didn't need the income right now. And then you're going to take it and then take a big, huge tax hit in a year that the taxes have been higher than they're assuming they're going to be higher. You know what I mean? Yeah. I think I'll stay. I'll just stay right here and continue.
Right. Yeah, I think that's something that's been discussed at some of our investor summits to date on the 1031 changes that might happen.
Honestly, I worry about that politicians these days, and this is both sides of the fence, honestly, don't study enough to understand the results of some of the things that they push. And that's been can be kind of deadly. I mean, if I look back in history to like Senator Roth, who made the Roth IRA, I mean, when he would introduce legislation, he would also introduce a whole bunch of really good stuff to show you how to use that legislation. That type of governing is missing from both sides of the fence right now.
Right. But I think with any change comes opportunity, and you can be on the side of people that complain, or you can be the side that adjusts and is more agile. And okay, what are those investors going to want now that they don't have 1031? Oh, they're going to want more opportunity zone, or they're going to want more tax protection somewhere else, or they're going to want more IRA or tax efficient structures. So I think that for a lot of investors listening, figuring out for your situation where to invest your energy and your time, I think it's really important to know where to focus your investment energy. If you're going to invest in operating businesses, what are the 1 or 2 industries that you want to focus on? If you're going to invest in real estate, what are the 1 to 3 structures, strategies, geographies you want to focus on? And then, are you making enough money, or are you worth enough to do the research on taxes and figuring out by talking to, Quest Trust and talking to a couple of professionals, where that low-hanging fruit is based on where you live and, what your business structures are. If you're in developing real estate or buying equipment or anything related to buying hard assets, et cetera, there might be big opportunity to do cost segregation studies or to, get tax benefits from that native business that you're already involved in. And I guess I forgot to add earlier, one key thing that you can explore with someone on the tax planning side is that if you have 2 investors going into a deal and one investor can use the depreciation, the other can't, it might be based on your operating agreement, but you may be able to use the depreciation that the other investor cannot by having a side letter with them.
That's so important when you introduce IRAs, right? Because sometimes the IRA has no use for a depreciation benefit.
Right.
So why would you leave that on the table, right? You definitely want to structure your deal so that the benefit no longer goes over. I'll give a basic structure, and then I want you to go in and fill in behind me that I think people miss in a concept, right? IRAs, unless you're hitting something that triggers unrelated business income tax, right? Your investment is tax-free. Now, if it's a tax-deferred account, you'll pay tax down the road when you remove it from the account. But as long as it's in that account with traditional or Roth, it's a tax-free investment. Right. If it's tax-free, it has no benefit of getting depreciation because they have not paying any tax. So what sometimes it might be better to do is to put the IRA in a different position than an individual, because the individual can pick up depreciation.
Right, for sure. There's a lot of things based on what you just said. So one thing is that most deals are not structured to be very tax efficient. So you can put those in the IRA. I mean, people make your life easy by being kind of lazy on the tax planning side. But the other thing is that maybe you're due some tax depreciation, but you say, hey, look, I don't need this. Instead of having it go to waste, why don't we talk to our attorney or CPA, see if we can sign over the depreciation allotment to you. And like right now, I'm dealing with this on one where the depreciation is $125,000. The tax benefit would be $45,000. And if it's allowed to do in the deal you're in, maybe you say, why don't we split it down the middle? I'll pay you $20,000 for your depreciation allotment, and you get an extra return that otherwise would have been left on the table if you didn't assign that depreciation.
It's a win-win situation that people walk away from all the time because they haven't taken enough time to look at structure. And structure, it needs to be looked at before you do the deal, not in the middle of it or after, right?
Right, for sure. And one deal that we're working on right now, we've structured the investment. This deal is already full capital-wise, so we're not raising capital for it. But we basically had 2 classes in the operating agreement for the members. You can be a class that uses the depreciation, and you get 1.5 times your money back as a gross revenue royalty. And you get 100% write-off on every dollar you put in there. So 1.5 times your money back. You know, if you're saving 40%, you're really putting $60 in, not $100. So getting 1.5 back, you're getting like a 2.2 times return on your money. Or if you can't use the depreciation, there's a separate class for those people. When they invest, they get 2 times their money back. So you can choose, and that way the investment is structured for people that want to come in and get the better tax treatment. Or if they don't need it, then you get a higher return. And it's good for the company raising capital as well, because they are basically redeeming equity once people get a certain return on their money. So it's good for everybody all around to structure it to respect what someone's tax situation is.
Richard, you're obviously very well educated. You're very well spoken on a lot of terms and things. So it's kind of a 2-part question. What education, or where could the audience, get in touch with you? What education do you provide to people? And what education resources do you personally use yourself? Like, where do you go to get to be such a smart and good-looking guy, Richard?
I go to Orange Theory 3 days a week and run up and down the mountains here in Scottsdale. So that's something I can do to contribute to not weighing 300 pounds, I guess, and staying healthy during this time. But I honestly don't want to get bored at my own investor summits. I also don't want to get bored growing our, we acquired commercialrealestate.com this summer, and we are growing, the privateequity.com investor platform, and we're just always hosting events. And after a while, after hosting 150 events, it kind of feels like Groundhog's Day. So to keep it interesting, like we have an event on Tuesday that's free for investors. So anyone who wants to come, it's not a sales pitch. If you're an investor, it's free. But we have 78 speakers on stage, and we have 12 different discussion panels over the 2 days. It's called the Family Office Super Summit. And at that event, I scripted every discussion panel question. So I scripted 144 questions for these 12 discussion panels. And I just asked what I'm curious about.
Right.
After doing this for a decade. And that way I figure if I don't get bored, and I've heard a lot of people speak on stage, then hopefully other people won't get bored. And so I'll do selfish things, like in Q1, I'm doing a tax strategy summit where we have 20 tax experts on stage in a single day. And that helps me get to my 100 tax interviews.
How do we get those? Is there a website that we can throw up in the chat box for them?
There is. I mean, it's familyoffices.com, but I just want to warn people, if you're an investor, it's absolutely free. If you go to our website, it's going to say, oh, you have to pay and become a monthly paying member to come to our events. And that's true if you're raising capital or syndicating deals. But if you're an investor and you're just looking for better deal flow and for knowledge and connection to peers, it's absolutely free. So you can just, if you want to email me at richard@familyoffices.com, then
I'll put that in the chat as well.
And,
say it again. Richard at what?
Richard at privateequity.com is probably easier for people to get right.
Well, they just threw up Richard at familysomething.com there.
Yeah, Richard@familyoffices.com is my
Yeah, that's what they threw up. So they got that. They got the private equity in there, and they got Richard at privateequity.com.
Cool. Yeah, it'll come right direct to me. But yeah, we built our whole business like you guys on giving away value. You said you did 600 events last year, and it's just giving away value in small rooms. And
well, for me, it's a no-brainer. My educated clients are my best clients. So
right.
Even if I lose money on the first 2 years, because we only make a few $100s in fees
right.
off an average client, getting them educated, what I find is they ultimately come out there and become my salesmen. And after that, they're rolling, man. They just know what to do. They call up. They have an IRA specialist in their pocket when they have a problem. They just do their thing, right? So
right.
I think that I think a lot of real estate investors miss that. Like if you've got a guy that's lending you money for the first time, you should go slow with them. Take time, develop that relationship, because it's not really about that deal. It's about all the deals that you're going to do with them over the course of their lives. And you're really good at that, Richard. And I think a lot of people miss that.
Right. I definitely think there's a lot of ways for us to be working more closely with Trust, because we both with Quest Trust, because we both think similar ways. We both produce podcasts and webinars, and I've written 13 books over the last 13 years, and people always say, well, why are you writing another book? Isn't 13 books enough? And I always say, well, when it stops adding value to people and I stop getting new good relationships from it, then we'll stop doing it. It's just like you guys doing 600 events versus 450 the year before or whatever. The more value you add to a niche community that you're genuinely is trying to add value, then people see that, and you de-risk the transaction of doing anything together, because now they know that you at least know something, or you wouldn't have been able to write the book or put on the webinar, et cetera. And they know you're not someone who's kind of a scarcity mentality, hardcore, sweaty, used car salesman type, and you're not someone they can't trust or is kind of shady and weird. And many times you get emails from people, and until you see a 1-minute video of them talking as a human being, everyone's skeptical, right? Like, who is this person? I don't know this person. Should I call them back? Should I email them back? And that's a big part of investing, I think, is just finding people you're comfortable with.
Have you ran into this? You have people come up to you on the street and like, I've seen your video, and you don't know this person. Like sometimes it's a little creepy, but I get that a lot these days.
Yeah, it is funny when that happens because of all the social media, and we do a lot of like geofencing social media thought leadership as well. And we've had the founder of Minecraft come in with his baby stroller. He sold for $2 billion to Microsoft, and he came in and introduced himself one day. And we have a lot of fun meeting people via social media, because we do a lot of local social media work typically.
That's good. Well, we're rounding up here. We have just a few minutes left. I know that Quest provides lots of education too, guys, and Haley will come up and put some things in there. We have YouTube channels and also just direct links on our website at questtrust.com. Again, it's always free. Most of our events are free. If we do charge for an event, it's just to make it bigger and better and bring in enough people to have you. All the money goes back into the event. I don't make money doing events. I don't know about you, Richard. I make money off of investing and running Quest. But in the final things, if you had one thing to say to everybody that you'd like to see them do this year, other than be kinder and safer to each other, what is it you would say in these last minutes, Richard?
I would say that integrity is power, and if you make everything integrated in your life much more so than it is now, then your investment results will be more powerful. You're going to be less stressed, and it goes from the food you eat to where you live, to who you hang out with, the media you consume, the audible books you listen to, what you do with your time. Do you exercise? What words do you say? Where do you focus your energy? How do you screen people? What are your values? And, do you have values for your family members above your kitchen table that you see every day and you talk about and you act on just like you would within a company? All of that comes down to integrity. And I think when people see that someone else is high integrity, aligned with their own mission and objectives, and they can identify similar things in themselves, and they're more likely to do business with that person or invest with them or to share deal flow or be helpful to them. So it really is more powerful because you get out of your own way. You also get other people that are distracting and energy vampires out of your way, but you also attract the right kind of people, and you just get so much more done the more you're aligned with who you are and where you want to go, I think.
Man, that's so wise, because integrity really is everything. If you've been around for long enough, you see it. You see the guys, they're coming in, they're making all the money, they're loud, right? And I had one of those experiences, and one of those type of guys. And Anne-Marie, my marketing director, told me that after COVID, she saw him recently driving a Lyft. You know what I mean? They fall out of the market. The people who stay here, make good money, are the ones that do show lots of integrity.
Right.
That their word is their bond, that they do try to take care of their investors. They're not just fast talkers. The ones that button down the details, because the devil's always in the details. And integrity should extend to all parts of your life. How you treat your family, your wife, your mother, your children. The messages and the legacy that we all leave comes in those things, and will never be the things that we can buy with our money. It's things that we buy with our intelligence and our integrity and our goodness to each other. And if COVID 2020's taught any of us anything, it's that we should all respect each other more. And I certainly take more time to thank my mailman, my Amazon delivery driver, my grocery store worker, and all the people who have struggled through this year to help me out.
Right, for sure. I read this book called The Daily Stoic, like one page of it per day in the morning. And there was a quote last week that I did a YouTube video on because I liked it so much. And it said, character is fate. And it's basically like your character determines your fate more so than almost anything else. Some of us start in more of a disadvantaged or advantaged positions, of course. But within that channel, your character is determining your fate. And then the only other thing I'd mention is that for 12 years, I kind of grinded out my business, and, I enjoyed it, or I wouldn't have kept on doing it on some level. But then I had a goal last year of having the most fun year of my life. And I went to Bali and Singapore and Tel Aviv and the country of Georgia and did a bunch of fun trips on a road trip. And I moved to Arizona to have more fun. I just did that here in July, and it's interesting once you think about that. It's like, why would you not want every year of your life to be the most fun year of your life? Like, is there anything more important than enjoying your life?
That's part of the core philosophy at Quest. We must have fun while we do it. And we talk about it openly, that if it's not fun, we don't want to do it.
Huh.
And you will be surprised how loyal that makes some of my people. Oh, you have such good customer service, such loyal employees. Why? Well, it's because, I know they're here for the same reason that I do. They want to make money. They want to do it faster, and they want to have more fun while they're doing it. Let's all do that, and then we'll all have fun. And we'll
right. Yeah, for sure. Well, I mean, wearing a bow tie shows that you like to have fun, I guess, on some level, right? So
I also like to do what my wife tells me. So she bought me bow ties.
That's funny.
Richard, it's been a real pleasure. I hope to do some more events with you over the course of this next year. And with Haley. Haley, are you back with us? You're going to tell us about some of our stuff? You're going to finish this out?
Yes, I certainly can. First of all, just to kind of echo what Nathan just said, Richard, thank you so much for taking time out of your day to join us. This is your first event with us, and I'm definitely excited to do more with you in the new year and, help bring your knowledge and education to our base here as well. So thank you for taking the time with us, guys. I hope you enjoyed this event. If you did, let us know in the comments. We always love to hear feedback from our events, what you liked, what you didn't like, the good, the bad. We always love to improve. And in our marketing department, I have a big hand in, helping to put on all of these events for you guys out there. So be sure to check out our other events, check out our upcoming happy hour this week, and don't forget to start saving for your children's education with those Coverdell education savings accounts. If any of you out there are interested in speaking with an IRA specialist, send us an email. I am terrible at multitasking, but I'll put our email in the chat here one more time before we sign off. Reach out to us. Let us know that you are on this event, and we'll have an IRA specialist reach out to you on Monday, help to answer your questions, schedule a consultation, and we can kind of go from there. And I hope you find all of this information really valuable. I know I sure did.
Great. Thank you both for having me here. Appreciate it.
Mm-hmm.
Richard, it was super helpful. Thank you, guys.
Take care.
Awesome. Thanks, everyone. Y'all have a great day. We'll see you in our next webinar this upcoming week.